Hey guys, my name is Mike Boyd, this is the Money Flare, and today I want to go over the reflation trade. Now I don't think it's getting much love anymore, especially after the past few months, and many are calling it dead. The market has definitely been giving it a beating lately. And when I say reflation trade, I mean the stocks and sectors that perform well when the economy is growing and things are looking good. So things like bank stocks and material and industrial companies, energy stocks, all the areas of the economy that can ride the wave of higher inflation and surging commodity prices. Basically, it's all the things that I talked about in my previous video on inflation, and it's also how I've been investing ever since May 2020. It's how the MF portfolio is positioned. And the reflation trade did quite well up until around 3 or 4 months ago when people on the market started getting worried about things like growth slowing, the Delta variant, and transitory inflation. All things that don't work out so well for the overall reflation trade. And what we've seen over the past few months is the market bet heavily on deflation, back to the status quo of the past 40 years where inflation spikes always fizzle out and growth and tech stocks and bonds are the places to be invested. So we saw bonds rally hard, the yield curve flattened, tech stocks like Apple, Microsoft, and Facebook rallied, and all the stocks that I was invested in took a huge hit. Now, I can't know for certain what the best bet in the long term is. Maybe the amount of debt that we have in the system is so crippling that we won't have any growth or persistent inflation. So maybe in the long term, betting on deflation is the right bet. But I made it pretty clear in my last video that I definitely don't see that occurring in the medium term. So let's say over the next 12 or 24 months. I think it's pretty clear that inflation will stay elevated and growth will continue to stay high. And I think the past 3 or 4 months, the market has been pretty confused. And I think overall it's been wrong and investors are not positioned well for what's to come. This is the same playbook as the last 10 years, and I believe that the market will be caught off guard by this. Again, as always, I focus on growth and inflation for my reasoning. And so first, on the inflation front, I've said many times before that rents can keep CPI elevated for months, and while other components of CPI come down, I think there's a very real possibility that the market will be surprised by how long CPI stays elevated. Secondly, on the growth front, I've said many times before as well how the consumer seems to be in a very good position right now. People have stayed home for the past year and a half. They've saved money and paid off debt. They delevered and have excess savings due to government stimulus rolling in, which will keep rolling in with the child tax credits, which will add even more money into their pockets, as well as all the other planned stimuluses down the line. We've already seen credit card spending increasing lately, and we've seen some evidence of potential wage growth as well, which puts even more money into the pockets of consumers. And now I sound like a bit of a broken record, but I've also mentioned before how well positioned the US banks are now. So compared to any other time over the past 10 years, banks now can start lending into the economy as consumers start to lever up and as companies start to rebuild their inventories, which have been very low lately due to all the issues related to COVID. And so this can keep broad money supply growing to keep inflation high and growth strong. We move in cycles, and we appear to be at the beginning of a new credit cycle where people will start to take on more credit and keep the economic juices flowing. And this past week, we've already shown signs that the trend appears to be shifting back to reflation. The market was worried about the job situation because we haven't really fully recovered all the jobs that were lost during COVID. There's still a really sizable gap. But earlier in the week, even though we had some bad ADP jobs numbers, it was clear in the data that the job openings are there. Companies have more job openings now than ever before, and for whatever reason, people aren't filling those jobs yet. Now, it could be related to all the benefits people are receiving right now to be unemployed, but either way, people will get back to work because the need is there, and the economy is primed, and this past week's economic data gave further evidence that growth is still looking really strong. The US July ISM Services Index, which is an index tracking the health of the overall services economy as opposed to the manufacturing part of the economy, that index rose to a record 64.1 in July. And on Friday, the US non-farm payroll reported 943,000 jobs gained, which beat estimates by a large margin. They also revised the numbers for June higher. So jobs are coming back and the economy is still looking good. Consumers are in a good spot and the bank's ready to start lending and growing credit. So overall, I think that things are looking good going forward, and I wouldn't be betting on deflation right now. We're already starting to see signs of the market switching back to reflation. Bank stocks on Friday had a huge bump up. They were going sideways for about 2 months, but now they're really starting to perk up, getting close to all-time highs again. Bonds took a huge tumble on Friday, and so we'll see if this is just a head fake or if this is a trend that will continue. I think a lot of the issue is that we tend to focus too much on growth rates and less so on the big picture. Teddy Valet on Twitter said it best. If you have, let's say, $100 of GDP that grows to $200, that's a 100% growth rate. Now, if the following year GDP grows from 200 to 300, that growth rate is 50%. So the growth rate slowed from 100 to 50%, but overall 50% is still pretty damn high, and it's much higher than what we've seen over the past decade. So why would you be betting against that growth? It's important to keep in mind the big picture. Pre-COVID, in January 2020, we had inflation at 1.9% versus 3.8% now, while the US 10-year bond yields were at 1.9% back then versus 1.2% now. So we have twice the inflation, and yet people are still betting even more on bonds and deflation. And it doesn't really make sense. And I think it speaks to the recency bias that a lot of investors have. They focus only on the past 40 years of disinflation and not on the fact that we always go through these inflationary and deflationary periods. It's sort of a cycle that repeats over and over again, and I think it will continue to repeat for as long as human nature stays the same. A common saying in markets is that bull markets, so markets that go up, are born on pessimism, they grow on skepticism, mature on optimism, and die on euphoria. Meaning, when a new economic cycle starts, people are always betting against it. They always have one foot out the door, waiting for the next big crash, because things look so bad. We were just in a recession. Markets are set to climb a wall of worry, and the mechanics of how this works is pretty simple. When everyone is betting against the market, that creates the opportunity for those same people to switch sides and rush back in when euphoria sets in, and when everyone thinks things are so great and never been better. That's when you really want to be nervous and start thinking about betting on deflation or the cycle top in the market. When we reach peak euphoria, you have to be on high alert, and we're not even close to peak euphoria yet. The stock market has been very frustrating for a lot of people lately because on many counts and by many metrics, the US stock market is very overvalued. And when people see how overvalued it is, they look at it and they get nervous and they call it a bubble and they always call for it to crash. But I always say that valuations are never a catalyst and markets can get much more overvalued. And with everyone currently betting on deflation and a market top, I can see markets marching higher for a while, especially the value stocks, the overall reflation trade. So you don't want to be sitting out of the liquidity bubble that we're currently in. But in my opinion, that remains the biggest risk right now to markets. We're in a huge liquidity bubble. We have too much cash flowing around that's going into stocks. And if we start to see liquidity dry up, that could be bad for all stocks, even the cyclical stocks. The market's not the economy, it's important to remember. And so even if the economy continues to do well, we could see stocks struggle. And we could be in for some trouble if this liquidity bubble eventually pops. And that largely depends, I think, on what the US Central Bank does, so what the Federal Reserve does, and what they're going to do going forward. They've been doing quantitative easing ever since March 2020, and they've been providing liquidity to the market. But with growth and inflation so high, they're going to start talking about tapering that support, so slowing down how much money, how much liquidity, and how much support that they're providing to the market. And that could be bad overall for stocks. It's worse, could be worse for growth stocks, but I'm not yet sure how these cyclical stocks, so the banks, energy, materials, the whole reflation trade, I'm not sure how that will perform in that environment. I think relative to growth stocks, they will do well, but overall, I'm not so sure yet. If they crash less than, let's say, Tesla or NEO or ARK, then that's good, but it's still not the best from a portfolio perspective. But that's not something that I have a lot of conviction in right now. I still believe that if we continue to see growth increase and inflation stay elevated, and the Federal Reserve starts to taper their support to the market slowly, and they don't freak out the market and cause a huge crash, then we could continue to see less liquidity, and then cash flows start to matter again. So valuations will start to matter again, and all of those metrics suggesting a very overvalued market could start coming down as growth increases and money rotates from the areas of the market that are overvalued to the areas that aren't. And in that situation, I think you're better off holding a copper or steel miner or gold miner than you are holding a tech stock. So that's where I'm going to stay for now, and that's where the MF portfolio will stay invested. The MF portfolio took a huge hit over the past 3 months during this whole deflation scare where bonds rallied and tech rallied and the whole reflation trade came down. But I didn't make any changes at all. I still believe strongly in holding reflationary stocks with some gold, Bitcoin, and above all, staying away from tech and bonds. With interest rates at 5,000-year lows and the valuation of energy stocks relative to the S&P 500 and mining stocks relative to the S&P 500 at multi-decade lows, I don't want to be betting on deflation and bonds. I want to own what is clearly cheap, unloved, which has a lot of convexity, and waiting for more capital to rush in. I'm not investing in an overbloated, high valuation tech company given the environment that we seem to be heading into. So everything that I've said in my previous MNET portfolio videos still stands, I think. Stick with reflation, ride the wave, stick with the trend until it changes. And I'll do my best to keep track of all the data and make sure that when that trend does change, I'll be on top of it. So I hope you guys enjoyed the video, and I hope anyone watching who is heavily invested in the reflation trade can rest a bit easier now. I think you're well positioned going forward, and that's how I'm investing my own money. And if you own a lot of tech and growth stocks, I would be careful personally. I've been wrong before, and this time could be no different, so I could be wrong. Maybe growth stocks will do really well, but regardless of what happens, I think it's very important to understand why you own a certain stock and understand what role that stock plays in your overall portfolio. Why do you own it? As can be seen from the recent crash in crypto, the market has a tendency to humble anyone trying to be cute and invest in what's trending and what's popular. And while some of that may have worked in 2020 and earlier this year with the whole meme stock movement, I don't know if that has any legs. So AMC and GME and Palantir and a lot of the other big winners of 2020 seem to be fizzling out. Tesla surprisingly looks okay, and I may be wrong about that one, but for the most part, the market seems to have moved on from the whole meme stock and unprofitable tech craze. So we'll see what happens. I definitely could be wrong, and growth stocks could do well, so I'm not going to say not to own any. There's no harm in owning some meme stocks or some growth stocks, but being too overweight that stuff could be deadly if what I think will happen actually becomes reality. Anyway, that's enough for me. I hope you guys enjoyed the video. Please be sure to like and subscribe. Be careful in these crazy markets, and I'll see you at the next video. Take care.